The RBA Governor.
It has been at 4.35% since November 2023. At that time, in November 23, the upside risks to inflation had increased, so the board decided to raise the cash rate to 4.35% from 4.1% to address those upside risks. Since then, inflation has fallen, and recent data suggests it's eased a bit more than expected. Growth in private demand has also been quite weak, and wage pressures have eased. The board therefore judged that it was appropriate to remove the cautionary raise undertaken in 2023. I've said many times that we need to see inflation moving sustainably towards our 2 to 3% target band before we ease rates. In December, we said we'd gained confidence that things were headed in the right direction. Now we're at a point where underlying inflation is at 3.2% and headline inflation is 2.4%. Inflation has eased over the past 3 quarters, and in the most recent quarter, a bit more than our forecasts had anticipated. This has increased our confidence further. It's clear that higher interest rates have been working as anticipated, restricting economic activity and putting downward pressure on inflation. The board judges it's time to reduce a little bit of that restrictiveness, but we cannot declare victory on inflation just yet. It is not good enough for inflation to be back in the target range temporarily. The board needs to be confident that it is returning to the target range sustainably. One of the big questions we're grappling with now that inflation is easing is how the labour market is reacting. The board's strategy has been to bring inflation down while preserving the gains in the labour market. The judgment was that we could achieve this with a gradual easing in the labour market. But the strength of the jobs market has been surprising. Many indicators suggest that the labour market is tight, and on some measures tightening further. While this is good news for job seekers, the board remains alert to the possibility that it is signalling a bit more strength in the economy, which could delay or stall the disinflation process. There's also a lot of uncertainty around the global outlook at the moment. One of the things we're cautious about is the possibility that policy unpredictability could lead to slower growth. But at the moment, it's too soon to tell. For these reasons, I want to be very clear that today's decision does not imply that further rate cuts along the lines suggested by the market are coming. As I noted, we've removed the cautionary increase that we did in November 23 to a level that we still see as restrictive. But the board needs more data and evidence that inflation is continuing to decline before making decisions about the future path of interest rates. The board is very alert to upside risks that could derail the deflationary process. I know that some other central banks have cut interest rates quite sharply over the past year, but we have taken a different strategy to most. Our policy rate was not raised as much as many countries overseas. We judged that while inflation expectations remained anchored, we could take a bit longer to bring inflation back to the target band, but we could keep unemployment lower. We can be happy with the progress we've made, but we have to be careful not to get ahead of ourselves. The truth is that some inflation pressures remain, and cost of living pressures are still front of mind for many Australians. The board is conscious that households with mortgages have had to adjust following interest rate increases since the pandemic. And the impact of high inflation over the past couple of years has permanently increased the price of goods and services. That's hurt everyone, but particularly those on lower incomes and the more vulnerable. The board will continue to look to the data to see if the economy and inflation continue to evolve as expected.